Mathew Owens, and welcome to the Masters of Real Estate. Do you understand the 1031 exchange and the power that it can give you to mitigate and defer your taxes or never pay those taxes back? There's some great tax strategies out there, and the 1031 exchange is one of them. So you can actually defer paying your long-term capital gains tax on any asset as long as you buy another asset that is as like kind as your asset that you're selling. And now there's some specific rules and things like that that you should fully understand when you are investing and doing 1031 exchanges and trying to take that tax burden off your plate and be able to actually save on those taxes. So let's talk about those a little bit. So first, understanding like kind. You can't go through and trade, sell a property and go buy stock, or sell stock and go buy property and expect this to work. It doesn't work that way. It has to be like kind property. So property for property, or stock for stock, or other strategies like that, or other assets. So being very careful about that like kind piece is extremely important. Also, you need to make sure that you never touch the money. It needs to be all handled by a 1031 exchange qualified intermediary, so that way they are controlling the transaction. They can set the guidelines for your repurchase requirements, and we'll talk about those and some of the things that you need to know to be able to do this successfully. So the 1031 exchange, the intermediary, the qualified intermediary, can explain to you what the rules are, what the requirements are, and make sure that you do that correctly. So it's absolutely worth having. A lot of people don't like paying them their fees to do that, but it's absolutely important to be able to have one in place, especially if it's your first one. You also want to be having them talk with your CPA to see if it's even worth it to do it based on your estimated gain that you should be having on this. So now you have to make sure that when you are selling a property, the property you're repurchasing hits some specific metrics. Okay, you need to be able to purchase a property that is of equal or greater value than your current property that you're selling. So if you're selling something for $1 million, you want to be buying something for $1 million or greater to hit that correct exchange. You also want to be using all of the net proceeds for that exchange and towards the new purchase, so that way you don't have tax on those proceeds. Now, you can not use all the proceeds and take some proceeds off the table and still be taxed on that percentage of the proceeds that you received, but you want to be able to go through and use as much as you can if you're trying to mitigate as much of those taxes as you possibly can. In addition to that, if you have any current debt on the building that you're selling, you need to be able to match that debt with the purchase building to make sure you have an equal or greater amount of debt when you repurchase. So repurchasing the property's value, the down payment, and the cash into the deal, as well as the debt into the deal, are the three primary components that you need to be targeting when you're trying to target a replacement property. In addition to that, you want to be very, very careful. You have 45 days to identify a property to go and repurchase after your sale occurs. At the closing, from the closing of your sale, you have a 45 days from there, and then you have 180 days to close that transaction. Now, you can go through and claim multiple properties as your replacement property, and there's some specific rules for that. So for example, you can do up to 3 properties and the value doesn't matter in that case, other than hitting your total sales value across those 3 properties. You can also choose as many properties as you want where the value, as long as the value is not more than 200% of the property that you sold. And then you can also have another option where you can choose as many properties as you want, even above the 200% value, as long as you end up closing on 95% of those. So there's some key things you want to look at when you're choosing multiple properties versus one replacement property to choose from. Now, understanding that when your new property, when you buy that new property, you have to understand that you have now an adjusted basis. Your new basis for your new depreciation is now limited because it's limited based on your old asset. So you're changing your basis of your new asset, and you're gaining less depreciation in the future on your new asset that you're purchasing. So, obviously, if you buy something that's much higher, then you get the additional depreciation for that higher cost above your current basis as well. That gets added to your basis. Understanding that for your future depreciation projections helps you understand, is the 1031 exchange even right for you in the first place? What kind of benefit does it give you right now? What other ways can you mitigate this to not have to do a 1031 if you don't want to? Because it can put you into a distressed purchase situation, because you got 45 days to find that deal, which can be hard sometimes, especially when you're in a seller's market, and being able to, close in 180 days. There's financing requirements and due diligence requirements. So especially for commercial property, that could be a challenge in a lot of cases. Also realizing that there are recapture rules and things like that you want to be careful about. If once you resell that property, and recapturing certain depreciation aspects, and then realizing you can't do this for your personal residence. This is typically not for personal residence. It's for investment property or business purpose property only. So being careful there, unless you split your residence in different ways, where you have a partial investment property and partial personal residence. There are some splits there. You want to talk to your 1031 exchange custodian and your CPA to find out what percentages and what the rules are there for that. Okay. So also, excluded properties are properties that are being held available for sale. So even if you're going through and doing a renovation on a project, and it takes you a year to get that done, and it's 12 months, and you are planning on reselling that property from the start, and you were never planning on holding that property, then technically you're not allowed to do the 1031 exchange. Any properties that are technically held available for sale, and that was the intent with regard to the property, then you're not able to do that 1031 exchange. But if your intent was to hold it, and you can prove that intent, maybe you lease out the property for a year or something and then resell it, then you can typically go and do a 1031 exchange in that instance, as long as you document what your intent was initially. Obviously, people's intents change over a period of time. So you want to make sure you're holding for that 12-month, rule there. And, understand, if you are an investor as well, if you understand that the 1031 exchange requirements and how to structure these for 1031 exchange buyers, you can be a much more valuable investor for your private investors by helping them to find 1031 exchange replacement property. This is what we do across the board. I'm a CPA. We've flipped over 1,000 houses now. We do a lot of seller finance type strategies. We set up property packages for 1031 exchange investors to be able to buy these with their down payment requirements, hitting their debt requirements, hitting their value requirements, and help them to add those replacement properties to their portfolio and trade up a lot of times into more cash flowing assets based on their equity that they have in these deals. So there's some great ways you can add value as a real estate investor to your capital sources and your investor buyers if you understand the 1031 exchange, all the intricate details, have the 1031 exchange custodians on deck to be able to help them, have the CPAs help them do the tax mitigation planning and things like that. So hope this helped. If you guys like this content, please like, subscribe, hit that notification bell, and we'll be coming out with other tips and tricks about real estate for you guys to learn and, continue your real estate investing with. Thanks so much.